Let us start by looking at how we estimate the cost of redeemable debt in calculating WACC. Before we go any further, there are important terms you must be comfortable with underestimating the cost of debt. These include the meaning of the following: bond, coupon rate, nominal value, and market value. The term bond refers to a security instrument that evidences a company's debt. It can be paper or electronic. The other name of a bond is a loan note. The coupon rate is the interest rate printed on the bond certificate, used to estimate annual interest. The nominal value, also known as par or face value, is the fixed amount stated on the loan note certificate that the issuer promises to repay at maturity. And the market value of a loan note is the current price at which the loan notes can be bought or sold in the financial market. It is the present worth of the loan note to investors today, not the amount printed on it. And this is typically quoted as the market value of $100 nominal value. Now, redeemable bonds are debt instruments that a company must repay at a specified future date, usually at their nominal value or at a fixed redemption price. To estimate the cost of debt of redeemable bonds, the approach is to find the internal rate of return of the cash flows associated with that source. The IRR is found as usual using linear interpolation, and the formula is as displayed on screen. The internal rate of return is also available as a spreadsheet formula than the computer-based exam. So to find the internal rate of return, the simpler way in an Excel spreadsheet provided in your exam is to insert in any blank cell the formula equals IRR, open brackets, put the range of cash flows, comma, open another bracket, then put a rate close to the result of the IRR as a decimal, then close brackets. However, it should be noted that when using the IRR approach, you look at it from an investor's point of view, making interest payments gross. Let us look at an illustrative example when using the IRR approach to estimate the cost of redeemable loan notes. From the information provided in the scenario displayed on screen, you are required to calculate the cost of debt for investors. Here, because the debt is redeemable, we make use of the IRR approach. To estimate the internal rate of return using linear interpolation, we have to define and identify our variable. As per the IRR formula, we need the lower cost of capital used, the higher cost of capital used, the NPV at higher cost of capital, and the NPV at the lower cost of capital. As for the costs of capital, let's assume the lower rate at 5% and the higher rate at 10%. Regarding the net present values, both at a lower cost of capital and at a higher cost of capital, we have to estimate this based on cash flows during the bond lifespan. So having defined our variables, we first list the bond years individually, which are year 0, year 1, year 2, and year 3, based on the bond lifespan of 3 years. The second step is to list the cash flows in the respective years. Now, because we are taking the perspective of investors, cash flow in year 0 will be the market value of the bond, which is $105. And this will be negative since this will be a cash outflow to the investors. Cash flow in year 1 will be the annual interest, which is 6% of the nominal value, and this is $6. And this will be positive since it will be a cash inflow to the investors. Cash flow in year 2 will be the annual interest as well, which is 6% of the nominal value, and this is $6. And this will also be positive since it will be a cash inflow to the investors. Cash flow in year 3 will include both the redemption amount and the annual interest. Redemption amount will be $107 if we incorporate the premium, and the interest will be $6 as usual. And both figures will also be in positive form since they are cash inflows to investors. The third step will be to calculate discount factors at 2 different costs of capital, 5% and 10%. The formula for calculating the discount factor is open brackets 1 plus R close brackets to the power negative n. R being the annual interest rate and n being the number of years. Applying this formula, we get 1 for year 0 at 5%, 0,952 for year 1 at 5%, 0,907 for year 2 at 5%, and 0,864 for year 3 at 5%. 1 for year 0 at 10%, 0,909 for year 1 at 10%, 0,826 for year 2 at 10%, and 0,751 for year 3 at 10%. The fourth step will be to estimate present values in each year under the 2 different rates. And if we do so, we get minus 105 for year 0 at 5%, 5,71 for year 1 at 5%, 5,44 for year 2 at 5%, and 95,89 for year 3 at 5%. Minus 105 for year 0 at 10%, 5,45 for year 1 at 10%, 4,96 for year 2 at 10%, and 83,40 for year 3 at 10%. Based on the estimated present values, we now have to estimate the net present values under the 2 different scenarios. If we do so, we get the net present value of 2,04 at 5%, and this becomes what we use for net present value at the lower cost of capital. At 10%, we get the net present value of minus 11,19, and this becomes what we use for net present value at higher cost of capital. If we apply the internal rate of return formula, we get 5,7%, which is approximately 6%, and this is our cost of debt. However, to verify accuracy in the exam, it will be wise to apply the IRR spreadsheet functionality, and if we do so, we get 5,8%, approximately 6%. We can see that this figure is similar to the one we got by using the formula, meaning our calculations were accurate.